Hello everyone, this is Dr. Leela. Today I'll be discussing on profit and loss account. Please do subscribe my channel. Profit and loss account. Every business want to know the income earned and expenses incurred during a particular period of time, and it is usually at the end of the year. The primary rule of any business is to sustain, and the guiding principle of business is not maximizing the profit, it is to evasion of losses. This was given by Peter F. Drucker. Profit and loss account is a part of financial statement. It shows the company's revenues and expenses. Profit and loss is mainly prepared to show the profits earned and losses incurred, and this can be for a month or a year. Profit and loss account, it is prepared for the statutory requirement, and the basic principle to prepare P&L account is to find how the business has performed in the past financial year, because this profitability helps a company to secure financing from bank. It attracts investors and also helps in growth of their business. Profit and loss account has three main categories. The first category is sales, and it is also called as revenue. And the second one is cost and expenses, and the last category is profit. Profit and loss account, it sets out the results of the trading activities of a company in a detailed breakdown of income generated and expenses incurred by them. Therefore, profit and loss, it summarizes the revenues, costs and expenses during a specific period, and also provides information about the ability and inability position of the organization. Significance of profit and loss account. The first one is it communicates about the net profit or net loss. That is, the objective of P&L account is to see whether the business has earned profit or suffered losses during the accounting period. And it also gives the information about the profitability position of the organization. And the second one is it compares current profits with past profits. That is, P&L account helps in comparison of the current year profit with those of the past year. It also gives the information regarding whether the net profit is in rising trend or downtrend. The third one is comparison of expenses. The comparison of various expenses included in P&L account in accordance with the expenses of the previous period, which helps in taking effective steps towards controlling the non-essential expenses. The last one is it acts as a basis for forecasting future performance. That is, on basis of controlling the current profit figures, previous period profits, it can estimate the future profits along with the projections for the expansion of the business. Important elements to be considered in profit and loss account. The elements are total revenue, cost and expenses, operating expenses, depreciation, amortization, and phenomenal income and expenses. The first one is total revenue. Total revenue is what? Revenue is the total amount of income that is generated with the sale of good or services, or it is the amount of money that is brought into a company by its business operations. Here, revenue is also called as sales, and revenue is at top line because it is displayed first on profit and loss statement. The elements under total revenue are income from operation and other income. Income from operation. Income from operation, it is also known as operating income or EBIT, that is earning before interest and taxes. It is the amount of revenue which is left over after deducting the direct and indirect operating cost from the sales revenue. Income from operation, it can be calculated by many methods, and the methods are total revenue minus direct cost minus indirect cost. This is one of the method. The other method is gross profit minus operating expenses minus depreciation minus amortization. And the other method for calculating income from operation is net earnings plus interest expenses plus taxes. And the second element under total revenue is other income. Here other income means it refers to the income that are not related to the operation of the entity. Sometimes these income will improve overall profitability. For example, you can take like interest on deposits from bank, income from selling non-current assets, interest charged to customers, etc. This and all you can take it as example under other incomes. And the second one is cost and expenses. In profit and loss account, the expenses are classified into two elements, and the elements are revenue and cost and expenses. Here revenue means money received by the company for the sale of goods or services, and the second element is cost and expenses. Here cost and expenses means money spent by the company for manufacturing of goods or for providing services. And the difference between revenue and cost and expenses is profit. And the third one is operating expenses. Operating expenses, it forms a major part of the expense and it includes costs that are not directly incurred in making a product or delivering a service. For example, under this you can take like rent paid, salaries, selling and distribution expenses, transportation, etc. This and all you can take it as example. Operating expenses, it can be defined as the expenses which are regular in nature and it contributes to the revenue of the business. And the fourth one is depreciation. Here, when a monetary value of an asset decreases over a period of time due to wear and tear or due to obsolescence is called as depreciation. Depreciation, it needs to be provided because it reduces the working capacity and effectiveness of the asset. Sometimes in calculating the depreciation we have different methods, and some of the methods to calculate depreciation are straight line method, diminishing method, annuity method. But here straight line method is considered as the simplest way in order to calculate the depreciation, and for calculating depreciation you need life of the asset, scrap value and cost of the asset. And the next one is amortization. Amortization, it refers to the process of writing off an asset over a specific period of time. Like depreciation, amortization is also recognized as an expense, and the only difference between depreciation and amortization is depreciation is for tangible asset. Here what is meant by tangible asset? Tangible asset, it is an asset which we can see, which we can touch and which we can feel. The examples for tangible assets is like plant and machinery, land and building, furniture and fixtures, motor vehicles, this and all you can take it as example under tangible asset. That is, depreciation is for tangible asset whereas amortization is for intangible asset. Then what is intangible asset? These are the assets which we cannot see, which we cannot touch and which we cannot feel. And the examples for intangible assets are patent rights, copyrights, trademarks, etc. And the difference between these depreciation and amortization is depreciation you are going to calculate for the tangible asset, whereas amortization is for intangible asset. And the last one is phenomenal income and expenses. Here phenomenal income is the income which is not recurring in nature. For example, like profit on sale of any fixed asset or insurance coverage received, this and all you can take it as example under phenomenal expenses. And here this phenomenal income and expenses are incurred based on the need of the business. Therefore these events are not regular in nature for the company. The example for phenomenal expenses are like loss on sale of asset, loss of stock by fire, etc. These and all you can take it as example for the phenomenal expenses. Kinds of profit. In general, what is profit? It is the revenue generated by sales minus cost and expenses. But in profit and loss account, we find different kinds of profits like gross profit, operating profit, EBITDA, net profit, and EPS. Gross profit. Gross profit is defined as the net sales minus cost of goods sold, and sometimes gross profit is referred as gross margin. And the difference between gross profit and gross margin is gross margin is measured or expressed as a percentage of net sales. Gross profit, it shows the basic profitability of a product or services. To gauge the performance of the company's gross profit, the company can go with both inter-firm comparison and intra-firm comparison. And the second one is operating profit. Operating profit is also called as trading profit or EBIT, that is earnings before interest and taxes. Operating profit is the profit earned from its business operations, including depreciation and amortization, and it does not include any interest or taxes. Operating profit is used as a gauge in understanding how well a company is being managed. Operating profit is closely watched and monitored by the investors because it measures the demand for the company's product or services and also the efficiency. And the third one is EBITDA. EBITDA, it stands for earnings before interest, tax, depreciation and amortization. EBITDA is a measure of company's financial performance, and it acts as an alternative to other metrics like revenues, earnings or net income. EBITDA is important because it can be used to analyze and compare profitability among companies and industries. And not only that, here it eliminates the effects of financing and capital expenditure. EBITDA is important because it gives estimation of the cash available to make interest and principal payments. The next one is net profit. Net profit, it is also called as bottom line because it appears on the last line of the statement. So what is net profit? Net profit is what is left over after deducting cost of goods sold, operating expenses, depreciation, interest and taxes. When you are analyzing net profit, you should also analyze whether the net profit has increased or decreased due to the operational efficiency or changes in other income. To measure the performance of the company, investors uses measures like or methods like EPS or price earning ratio, that is earning per share and price earning ratio. The difference between gross profit and net profit is gross profit, it refers to the company's profit earned after subtracting the cost of producing and distributing its products, and net profit, it indicates a company's profit after deducting all the expenses from revenues. The last one is EPS, that is earnings per share. It is an important financial measure and it indicates the profitability position of the company. EPS acts as a tool for the market participants to measure the profitability of the company before buying its shares. EPS is the portion of the company's profit that is allocated to every individual share of the stock. And the decision rule for EPS is higher the EPS, that is higher the earning per share, better is the profitability. And one small note, that always you remember that profit is an estimate and you cannot spend on estimates. And the formulas for calculating all these profits is, first one, gross profit. The formula is sales minus cost of goods sold. And the second one is operating profit. The formula is total revenue minus operating expenses. And the formula for EBITDA is net income before tax plus interest expenses plus depreciation plus amortization. And the fourth one is net profit, and the formula is total revenue minus operating expenses minus depreciation minus interest tax. And the last one, that is EPS, the formula is PAT, that is profit after tax minus preference dividends, dividend divided by total number of shares outstanding. Thank you.